A generational wealth building opportunity in the stock market is happening right now, and not many people actually notice that it's even happening. And the window to make your investment is closing very, very quickly. So, in this video, I'm going to break down the good, the bad, and the ugly of the stock market and the economy right now. And I'm going to show you what not many people are looking at. And if you deploy your money in this certain way, you can make generational wealth by doing this certain type of investment. And before we dive in, I just want to be completely honest with you right now. I don't care if these videos get views. I'm not going to beg you to like the video. I'm not going to beg you to subscribe. We're all here to make money. I'm here to make money. You're here to make money. So let's break all this down in a no clickbait, no BS, no fluff way of what's actually going on in the economy right now that no one's talking about, and how to deploy our capital to make a bunch of money doing this. So here we go. All right, so we're going to break all this down in my 100% free newsletter that I send out every Sunday. And the first thing that I want to look at is the Fear Greed Index, because so many people look at this, but not many people know how to actually use this to your advantage. So right now we're in the extreme fear category at a reading of 21. That's basically meaning that everybody is freaking out right now. These tariffs are going in place, potential recession fears, the stock market's crashing, inflation might go up. We might run into stagflation, which is honestly really, really bad. So people are pricing that into the Fear Greed Index, and this is very fearful right now. Now, as you guys know, the famous quote that Warren Buffett says, when people are fearful, that is a time to be greedy. So here's the deal, and this is the whale in the room. Trump is putting crazy high tariffs on pretty much every single country, and it's just freaking investors out. I get it that the tariffs are on a 90-day pause for every country except for China. But what happens when 90 days runs out and we don't make a bunch of deals with these countries? Tariffs are going to go back on, and we're going to go back into this trade war fear with all these countries going back and forth. And China, which is the whale in the room, we are at a 145% tariff on Chinese imports into America. So this is causing massive disruption in supply chains, massive disruptions in prices. And really, the economy is just being crippled by this because prices are going up and we don't know where we should buy our goods from. So this chart shows you the US effective tariff rates going all the way back to 1920. One of the key things that I want to look at before we go over to the current rate here is that the Smoot-Hawley tariffs that went into effect in 1930, this happened right after the Great Depression, and they put tariffs on all these other countries to try to help support American industry, but it actually made the Great Depression much, much worse. So Smoot-Hawley was an absolute flop, and it was really, really bad for the economy, and that dragged out the Great Depression for many more years than what it actually had to be. And you can look on the right-hand side, the Trump Trade War 2.0, and you can see that the effective tariff rate is even higher than what it was with the Smoot-Hawley tariffs in 1930. So this is very, very bad. Now, I get it that I'm talking about a lot of negative things right now, and you're like, Brandon, I clicked on this video to know the bullish case of how the stock market's going to moon and go straight up and how I could deploy my capital to make money on that. We're going to get into that, but I just want to show you the bad stuff that's being priced into the market right now. And I think that maybe the market's being too bearish on some of the stuff that I'm going to start presenting to you. There's a few more things we have to go into, and I'm going to make my case with all the bearish stuff that's being priced in. Then I'm going to tell you why I feel like most of the bearish stuff that's being priced in is going to get reversed out of the market. And when that happens, the market's going to go straight up. So you have to understand everything I'm going to explain to you in this video right here, or you're not really going to understand exactly what to do with your money. So very simply speaking, the reason why tariffs are bad is because tariffs make the price level go up, causing inflation. But when the economy is slowing down and inflation's going up, that brings in stagflation fears where the economy is taking a crap and inflation's going straight up. So if we actually have these US effective tariff rates of over 22%, this is going to be very, very inflationary to the US consumer. Inflation will go up, and the Federal Reserve is going to be in a very, very tricky position of what to do with interest rate policy. Now, if we take a look at this chart and go to the blue line right here, this is headline CPI, and for March of 2025, it was 2.4%, which is pretty good. The Fed's target is 2%, and you can see after COVID, inflation went straight up over 9%, and we're coming all the way down, and we're very, very close to this 2% target right here. But for Q1 of 2025, which is a 2.4% right here, not a lot of the tariffs were actually in place. So I am expecting inflation to tick up just a little bit, but inflation is also going to be dragged down by oil prices going lower, because oil prices into the CPI index right here is roughly 10%. So when you have a 10% negative factor going into this, and then you have tariffs going up and causing overall inflation to go higher, they're going to kind of balance each other out. But I think that tariffs overall are going to be a stronger impact than oil prices going down. And if the economy happens to make a turn for the better and maybe we don't have a recession, oil prices are probably going to go up because it's being priced in that there's going to be more demand for oil, more travel, more people just spending money on gas and oil. So that'll make the price of oil go back up, and that'll be bad for inflation again. So if you're Jerome Powell at the Federal Reserve and these tariffs stay in place, but the economy goes down the tubes, what are you going to do? Because you're juggling these two tricky things right here. You want to make the labor market strong, but you don't want to let inflation run out of control. So what Jerome Powell said at a recent interview is that he's going to let inflation run a little bit hot because he sees tariff inflation as just a one-time price level hike, and it's not going to be around for a while. It's going to be transitory, as he said. But going back to this chart right here, he said that this inflation right here was going to be transitory, and it went all the way up to 9%. So that's why that transitory word makes a lot of people freak out, because what if we go all the way down close to 2%, the tariffs stay on, the price level goes way up, and inflation goes through the roof? I don't see how Jerome Powell is going to not keep interest rates higher for longer or even raise interest rates to try to bring inflation down. Because going back hundreds and thousands of years, inflation is what brings down empires. Inflation is what brings down countries and brings down currencies because there's no faith in that currency and that country. So Jerome Powell is by no means going to let inflation get out of control. And you could go back and look at 1980. The federal funds interest rate was almost 20%. They raised the interest rate to 20%, and right now it's 4%, 4.25%, just so you know. They raised it all the way to 20% because inflation got totally out of control. And if they keep raising interest rates to try to bring inflation down, if it goes up to 20%, the stock market's going to absolutely crash. So yeah, I get it. There's some pretty bad things I'm talking about right now that actually could happen. And we're going to turn the corner in just a second, and I'm going to show you why I don't think any of that's going to happen, and I'm going to prove it to you actually. All right, so we're going to do a general look at the S&P 500 right now. We're going to put our bullish hats on, and I'm going to explain to you why it's actually a really, really good time to get invested in a market right now, and certain companies to look at that are going to capitalize on the massive once-in-a-lifetime generational wealth building opportunity that is happening right before our eyes right now. I know I said a lot of bearish things recently, but for the rest of this video, I'm going to tell you why I don't think most of those bearish things are actually going to play out and how you could capitalize on it when those things get priced out of the market. Because right now, like we said on the top, peak bearishness is priced into the market. You can see the fear greed index right here. We're at a 21. So when we're at a 21 on the extreme fear category, all of the bearish things I talked about are now being the base case situations, which means pretty much everyone's guaranteeing that to happen or they're pricing it in to happen. But I just think it's very, very unlikely for it to actually play out. So the purpose of this video was to break down the bullish situation in the market and the bearish situation in the market so that you know yourself as an investor of what's actually going on out there and what I personally expect to happen. I didn't give you my opinion yet. I'm going to give it to you after I do this chart right here because I want you to have all the information that actually matters, and then we can make a logical decision on what we think is going to happen in the market. So I've talked about this chart before on the channel, and it's a very, very good chart, and I added a couple things on here so you could see what I'm talking about even better. The lighter line right here corresponds to the S&P 500, and the darker line corresponds to the earnings per share growth. So when the S&P 500 falls below the earnings growth rate here, this is a time to be bullish in the stock market because things are cheap. Now, closing out 2024, this was a great time to be bearish actually, because look at the distance of the S&P 500 actual stock price index versus what the actual earnings per share is. So this is saying that the market is lofty and it's disconnected from the fundamentals because the market went up way faster than what the actual earnings did. Now, the market did fall quite a bit. We're down roughly 20%, and we're technically in a bear market right now. So right now, is it a good time to buy? Well, it depends, but there is certain companies and certain sectors that I'm going to talk about in just a second that I feel like are extreme buys right now. Up here, as we already said, the market was overvalued. We took a 20% dip, and now these lines are very close together. So the earnings per share growth and the actual stock price growth, these numbers are going to basically be the same percent gain in the long run. This is a 10-year chart right here. But if we go back and look at like a 30-year chart and then 30 years ahead, these lines are going to follow each other in tandem, and then the stock price index is going to go above and below the earnings per share growth line, but overall they follow each other. So right now they're pretty much overlapped, and this is basically saying that the market right now is at intrinsic value. So it's not a very, very bullish time, but it's definitely not a very, very bearish time. It's just like walking into a car dealership and you're just paying MSRP for the car. You're not getting a deal, but you're also not getting ripped off. So if you have a longer term time horizon and you like to sell put options, which I love selling put options, I generate a lot of premium doing that, a lot of cash flow. I feel like this is a very, very good time to sell long duration puts on various different companies and ETFs. Now, going into what you came here for, you want to talk about the once in a lifetime generational wealth building opportunity that's potentially happening right now. Look at this chart here from SnapLogic. 89% of employees believe that AI could support them in up to half of their workload. And I think you just need to think about that and not just say, oh yeah, Brandon, 89% said it could do half their job. It's not like that. Because if you're an employee at a job, think about how much more productive you could be. If you're more productive, think about Amazon, for example, with robots and AI and stuff like that. How much more productive can they be to optimize their warehouses, their supply chains, and how they deliver packages with the help of humanoid robots and just robots in general, moving boxes around and pretty much automating the entire workflow? Think about how much more productive that company is going to be. That company is going to be more productive. They're going to have more top line growth, more bottom line growth, which is their earnings per share. And when earnings per share goes up, the stock price is going to go up. And that's essentially just a massive boost in productivity. Now, stay with me here for a second. If you have all these companies that are integrating AI into their workflows that are becoming way more efficient and way more productive, they're not going to have as many employees. When you don't have to have as many employees, and actually your employees you have are becoming way more productive, they're going to make a lot more money for your business, and you're going to need less of those employees. So over the course of the next 10, 20, and 30 years, mark my words, I believe strongly that the unemployment rate is going to slowly trend up because we're not going to have to work as much. Our standard of living is going to keep going higher, and we're going to have all these robots working for us doing so many productive tasks that us as humans doing general tasks like a cashier or working in a warehouse, we're not going to be able to find jobs if that's what your job is. You're going to have to do something else. There's going to be new jobs like robot mechanics and stuff like that come out. But what I'm getting at is this. If you don't invest your money right now and you're in an industry that's potentially going to get wiped out by AI and humanoid robots and self-driving cars, you are going to get screwed. You have to invest your money right now and don't worry about what all the news headlines say. Maybe the market goes down a little bit more and you ride a little bit of that red wave down, but the market is going to recover. We're not going to go into stagflation for the long term because stagflation just doesn't make sense. If the economy is going down the tubes, that means there's not a lot of demand in the economy to go buy goods. If there's not a lot of demand to go buy goods, how are you going to have upward inflation pressure? You're probably not, and if you do, it's just going to be short lasting. As for a recession, if we do have one, it doesn't really matter if we have a recession because it's just 2 quarters of negative GDP growth. The US economy is going to bounce back. Also, understand this. I am very optimistic that we are going to make trade deals with pretty much all these countries, including China, because if we don't, the Republicans are never going to get elected again. Midterm elections are going to come around sooner than you think, and I guarantee you that Trump is going to want to have the stock market very close to all-time highs by then, so he's going to make trade deals with China and these other countries so that the Republicans don't get voted out of Congress. So the tidal wave of AI is coming, and a lot of the big AI companies that are on sale right now, very, very cheap to their intrinsic value, like Triple Q, which is the ETF that tracks the NASDAQ. A lot of the companies in the NASDAQ are big on AI, and I think the NASDAQ, the Triple Q, is going to do very, very well going forward. NVIDIA, Meta, Microsoft, Tesla, Broadcom, Micron, etc. There's so many other companies out there that are going to do so well in this environment for the next 5-10 years going forward, but you just have to see through the short-term volatility and you have to capitalize on the market. Remember, the VIX is high, the volatility index is still very, very high. Historically, when a VIX is high, when there's peak bearishness priced into the market, and when we have this massive AI tidal wave that's coming and these companies are on sale, I just feel like right now is a very, very good setup to start getting invested and start deploying capital. I'm doing stock options, I'm buying shares, I'm doing various other strategies to capitalize on this dip, but I'm by no means betting the house. I'm not YOLOing calls, I'm not doing crazy stuff. I am keeping my ratios in check and I'm managing risk appropriately because in the event that we fall lower, I still have money that I could go buy the dip even more. So I'm just looking at 5-10 years down the road from right now. I'm not worried about what the market does in the next 1, 2, 3, 4, 6 months. I care about 5 years, and I'm going to capture the gross movement, the big movement that's coming in all these individual companies and the Triple Q index. So if you want to learn how to do all that stuff in stock options, click the link below to get into my course. It's 50% off right now. It's going to totally change your life. But if you don't want to do that, watch this video right here. It's the 10 ultra critical things that you have to do right now to scale in 2025. I'll see you guys there.